All righty, as it's the top of the hour and people are still joining, I'll get started with a few agenda and housekeeping items before we get into the meat of the topic today. Let me say hello to everyone. I'm Lauren Kelley, CEO and founder of OPEXEngine, SaaS benchmarking platform for small and mid-size SaaS companies up to almost $1 billion in revenue now. We have enough benchmarking data to cover larger companies now. And I'm just super excited to be here with two great guests and to be able to talk about a topic that is a perennial topic in the SaaS industry. Today, we're going to talk about why does it matter about COGs? And we're going to also talk about how to define COGs, as well as the gray areas and the difficult areas, as well as some recommendations and best practices. So as people are still joining, I'm going to also just do a little bit of housekeeping. This is an interactive webinar. It's part of OPEXEngine's monthly SaaS Conversations webinars that we have every month on operational topics. Please feel free to sign up so that you get information about them every month. And for those of you who have participated before, we always have a very interactive discussion. So please put your questions in chat. We have time reserved at the end of the webinar, as well as if we can catch some of the questions that are applicable to what we're talking about we'll answer them during the webinar. And if you have questions afterwards, just let us know. We're all happy to answer that. So with that, I want to introduce these two great panelists we have today on this topic, both of whom I've known for quite a while. Todd, I can't remember when we first met. It was
a while ago.
All right, we won't specify any specific dates, but it was some time ago. Actually, I believe before you started SaaS Capital. But you have been in this industry and you have done some great writing on both this topic and a number of other topics. So I'm super excited to have you here. And Eric, I also won't say exactly when we met, but we've worked on a number of projects together. You have brought so much clarity to a number of the companies that you've worked with, and you've been benchmarking with us, and I'm thrilled to have you here today. So just to sort of kick this off, Todd, maybe you can give us a little bit of your background and why COGs?
Why COGs just is the most important thing in my life, right?
Absolutely.
No, thanks for finding the one picture of me where I have a tie on. Like
it
the
was
only
hard.
time I've had a tie on in 25 years.
We searched.
Yeah, you did a good job. So yeah, I've been focused on SaaS companies for a long time. I was in venture and investing in SaaS businesses, and then founded SaaS Capital and ran that for 13 years. And so I've looked at thousands of SaaS company P&Ls. That's not an exaggeration. It's literally over 2,000. And this is a topic I started writing about almost 10 years ago. And at the time, I was just really shocked that there are no standards for this. I thought, like in FASB and GAAP, there would always be standards about what the rules are, and there aren't. And this is an area that investors look at very, very closely. So I'm here to bring the investor perspective, having seen a whole bunch of these. And since selling SaaS Capital, I now advise SaaS companies. I do thought leadership things like this. I do thought leadership things on behalf of SaaS companies, as well as engage in like M&A advice and corp dev and things like that. So super happy to be here and chat about COGs.
Terrific. Well, thank you. And so we have the investor perspective, and then coupling that with the operator perspective from Eric. Eric, why does COGs matter to you personally? How'd you get here?
Well, thanks, Lauren. And first of all, it's a real honor to be here. The COGS issue has come up repeatedly over the past 7 years, during which I've been involved in serving as interim CFO for SaaS companies. So I've written about this. I've leveraged OPEXEngine for benchmarking, and it seems to continue to be an important issue for folks.
Absolutely. Well, with that, let's get started. So as long as we're talking about it, let's just talk about why it matters. So Todd's written some great stuff recently, and if you get a chance, follow Todd in LinkedIn, because investors care about it, and it also affects valuations. But it's also just really important, and Eric has done some, written some great article on this and updated it recently. Whether you're calculating it correctly, or if you're, I should say, you should be calculating it correctly, but it's important to know what your model is. And just like lots of other SaaS metrics out there that everybody is, there's the hype about various metrics. What your COGS is, if you calculate it correctly, and your gross margin really helps identify where you are as a company, and that helps you identify the peers that you want to benchmark yourself against. It doesn't make sense, speaking as a benchmarking company, doesn't make sense to benchmark yourself against something that you're not. You can benchmark yourself against something that you're not because you want to get there, but COGS is probably one of the areas that is hardest to change. You can change your sales and marketing expense and change your sales model, but you can't change your cost of delivering your products that easily. So Todd, you were nice enough to share with us some of your recent analysis that you did here. Maybe you could talk a little bit about that.
Sure. The overview here, I think a good way to conceptually think about it is, why does gross margin matter so much for valuation of SaaS companies? It's because, as we all know, SaaS companies are valued on multiples of revenue. And it's very intuitive. A high gross margin dollar of revenue can generate more future profits than a low gross margin dollar of revenue, so it's worth more. And so it's an important component. The chart here shows the relationship, and I'm sure many of you have seen this chart before, between growth rate and the revenue multiple. So even though gross margin is important, growth rate has always been the most important metric when valuing a SaaS company. And so you can explain most of a revenue multiple by knowing the growth rate of the company. But as you can tell, you can't explain it all. If you could, all of those dots would be on one single line. And although it's a little hard to see, you'll notice that there's some outliers, right? There's a company at the top, there's a green dot. It's growing about 65%, but it's worth 60 times revenue. And at the straight down from that, there's another company that's growing about the same, a little bit less, but its multiple is 20. So we're trying to figure out, how do you explain those differences given that the growth rates are very similar? And the answer in this case is you can mostly explain it by their gross revenue. So if you flip to the next slide, Lauren, you'll sort of see those dots. And again, this is hard to figure out, and the yellow one's a little easier to see. They much more closely correlate with this view of the revenue multiple. And it's because we incorporated, hey, what's the gross margin, right? So the easy way to do that is just take the growth rate times the gross margin. And you can tell that these companies sort of are much easier to explain in terms of valuation. And the bottom line is the yellow dot company has a 50% gross margin, and the green dot company had a 90% gross margin. So in this data set, the average gross margin was around 73%. So one is just generating much less available profit per dollar of revenue. And so its valuation is lower than it would be for companies with similar growth rates. The opposite is true with the green dot, right? It's getting a higher valuation than you would expect given its growth rate. So that's why it matters. And it's also true on the margin. We focused on the outliers, but a point or two difference in gross margin can impact your revenue multiple in both the public and private markets. So the next page, and I promised Lauren I wouldn't go into this in detail, but we will send out a spreadsheet later You can actually mechanically adjust for the gross margin by basically equating it to an expected gross margin multiple and then backing into an adjusted revenue multiple based on what the average gross margin was at the time. So we'll share this spreadsheet, but this is applicable if you're thinking about private company valuations and you're like, oh, I've got a SaaS company, it's 3 million in revenue, it's growing at 75%. Great. What's its gross margin? If it's well above or below the median, you're going to need to adjust for that because investors absolutely care what's driving that. And that's why it's important to have a common definition and have it equate to what the standards are in the industry.
Exactly.
Yeah.
No, that's great, Todd. And I think that, you know, here's a slide that we put together, and part of it's also, and again, here, these slides are all talking about mature companies. So obviously immature or younger companies, you know, may not have optimized their expense management at that point. But the key point is, even if you look at the Bessemer Cloud Index companies, they're not all SaaS companies. SaaS companies typically would have a gross margin, you know, in the 70 to 80% range. And companies that are under that in terms of gross margin, especially if they're mature, typically are not enterprise, you know, SaaS companies. They're infrastructure companies, they're technology-aided services companies, and there's something that's dragging down the gross margin. So that's something we want to talk about. But again, you can't make yourself into a different company. And as Todd, I think your slides really well, you know, show that an investor is going to look at a company that can return 90% on each dollar versus a company that can return 50% on each dollar. In order to produce the same amount of profit, it's going to have to work almost twice as hard, and that can take a lot of investment to make that happen. So
the takeaway is not we're encouraging folks to inflate their gross margin because you won't get away with that. Investors, public or private, will really peel it back. But it's also, don't shoot yourself in the foot. Like, you don't need to include things in there that most people don't include in there. And then you need it to run your business, which Eric will get into in a moment.
Exactly. So with that, we want to talk about a little bit on, you know, how, you know, COGS is an accounting term, so it should be easier than it is. Why is it worth having a whole webinar on this? And Eric, maybe you can, this is from part of your article about it, is just thinking at a high level, you know, what are you supposed to be doing when you classify items as COGS versus OPEX?
Yes, thank you, Lauren. And to echo what Todd said, we don't have a lot of guidance, formal guidance on how to report COGS. If you look at FASB, or if you look at Reg SX, which is an SEC document, what the only guidance you get is that gross profit is revenue minus expenses. And so it's really left up to the operators to understand and to get this right. And what we're seeking to do is achieve both accuracy, so the accuracy and precision of COGS. The best guidance that I've come up with, and in thinking about this, is concepts, that accounting concepts, and then applying those to segment out the costs. So we have direct versus indirect costs, which we all know direct costs goes to support the customer directly. So in Todd's example, Twilio white labeled SendGrid and ultimately purchased SendGrid, and they send out massive text campaigns. Well, they pay a fee for every text that they send. So that's an example of a direct cost. It's also an example of why their gross margin is a lot lower, because they incur those costs. An indirect cost would be a cost that is not needed for the customer to operate. So if you have someone working, even if it's on the product, if if the product can operate without that person directly working on it in that time, then it's indirect. The matching principle this becomes really important, especially when we talk about customer success and customer support, which we'll talk about. But when you record expense for a certain period, that expense has to be a direct cost in that exact period. So matching principle. And then customer obligation, you may need, and this again is a customer success discussion, but you may need to incur expenses because you are legally obligated to field a customer support team, or have a group of people standing by, or to have someone monitoring your customer, and that the customer, you're required to provide that to the customer, and therefore that would be a direct expense or in COGS.
And that's really, that's a great launch point to the gray areas, because if you're a smaller company and you don't have a full customer success and customer support organization, and even though your customer success is primarily doing renewals, if you legally are obliged to have somebody standing by to be able to answer technical questions, and it is the customer success people, then does that mean that they then become part of COGS, even though they're also selling?
Yeah,
Okay.
I think we'll talk about that, but it's an area that I get asked the most questions about.
So generally, and you can see loads of blogs out there and loads of references, and we have a blog coming out tomorrow, and we're going to list a lot of these things. These are from your blog, Eric. The big buckets that everyone puts into COGS are hosting and infrastructure, customer support, professional services, and then your cloud operations and platform support. But then, like everything definitely in this area, the devil's in the details of capitalized internal use software versus and purchase technology, third-party fees, overhead allocations. Maybe I'll ask you, Eric, first, just could you give some examples of where you've seen companies go wrong on that, and also where it's been really tough to get an agreement within the company of where it fits, and maybe agreement also with your accountants?
Oh, great. And I'll go through, I can give an example for each one of these. So hosting and infrastructure is your bandwidth, your storage, and your compute power. And typically that's in the cloud, Azure, AWS, Google Cloud Platform, or maybe you have a hybrid cloud. The biggest challenge that I find companies get wrong here is that you have to remember, if you're using, say, for example, AWS, you will have a production environment, and that runs the software for the customer. And then you also have a dev environment, and that's where your software is being developed. Your engineers are going in every day, and they're writing code, and they upload it and to this dev environment. So that software development, which may even be capitalized, sits in R&D, and therefore hosting and infrastructure expense associated with that should be separated out.
It's a great
customer
point.
Support is a key issue, and I think the challenge I see a lot of companies, most specifically, I think of one example where the company took every item that had customer in it and put it in cost of revenue. So customer support and customer success were both included in cost of revenue. And these are very different things. The customer support team is available at any moment to take calls from customers and are expected to resolve low-level issues, often called level 1 or level 2 issues. And these are, I can't access, my password's not working, or this is down, or how do I use this button? These very simple sort of issues. Higher level things go to the engineers, which are incorporated into the platform, and those are indirect. But customer support, and you'll hear people say level 1, level 2, belongs in cost of revenue. Customer success, going back to the direct versus indirect, they are available to support the customer. They reach out 90 days, before the renewal, and they are supporting the customer through training, guiding them through the contract practice. This is where the matching principle comes into play, where they're helping customer success and driving lifetime value. So value over the lifetime of the contract. So it's customer success typically belongs in sales and marketing. Professional services, a lot of this depends on you implement it. So you're implementing the software, or you typically implementing the software. That's what that means.
Let me just interject there for the
enterprise companies have some level of integration or implementation or even training involved, and those are inside of the cost of revenue. Cloud operations, cloud support. Increasingly, you'll have a platform ops team, and their job is to keep the platform running and ensure security. So oftentimes you see a mix of infrastructure and security people. The biggest challenge there is a lot of people put security down in R&D because it's seen as more of an R&D function. Capitalize internal use software. So if you are building software that directly supports a customer, typically I see this as billing software, or if you purchase technology like Twilio, purchase SendGrid, those expenses would be put into cost of revenue. Third-party fees. I can think of a specific example with a cybersecurity company that bought information off the dark web, and those fees are in revenue, in cost of revenue. Finally, overhead allocations. If you truly want to benchmark your company correctly, you'll need to have overhead allocations. So this is facilities and G&A provide support to all departments, and those allocations should be set up, and you should allocate G&A to R&D, sales and marketing, and cost of revenue. So sorry, that was a little long-winded, but example.
Yeah, that was good. I have
That's terrific.
A few comments, and really this comes from the smaller company perspective, where you might not have all the resources to do all these things. One in particular is customer support, because in an early stage company, you might have 5 people, right? And they're answering the phone, they're doing renewals, they're doing cross-selling and upselling. So allocations are fine there, work with your team and see where they're spending most of their time. And anything that's related to sales and marketing should go down below. The only caveat there is don't mess with those allocations frequently. Consistency is as important as accuracy. So just don't mess with those monthly, maybe once a year, take a look at them. On professional services, it does belong in COGS. If you can, it's always great to match that against a services revenue stream. So the investor can say, okay, here's what you make on software, right? And here's your professional services line of business. How big is that? Its gross margin is always different. Are you using that as a loss leader to really, generate sales because you're not charging enough? So it's great if you can, on the income statement, sort of match those two things with each other.
Actually, oh, sorry. Can I just ask a question on professional services? Because it's been my experience in smaller companies, if you do have professional services, you may also occasionally use those personnel for sales engineering to do, prototypes for customers or demos and help out the sales organization if you don't have that infrastructure in place. So that's a sales effort and not a COGS effort. So I've worked with companies where we've, allocated a certain percentage of professional services expense to sales as compared to into COGS.
And I think early stage investors are fine with that, and just be clear about what it is, and don't mess with it on a regular basis, or you'll create noise in the P&L that doesn't really tell you anything. And the other, overhead allocations, a lot of small companies just don't do that. So you can if you want, but in terms of benchmarking against your smaller peers, most folks aren't doing that. If if they put the salary cost in there, but not tables and desks and chairs.
To that point, from our perspective, we generally say companies under 20 million, the norm is not necessarily to allocate, but anybody over 20 million should be allocating, or at least doing sort of basic allocations. And it gets more complicated as you get bigger.
Eric, were you talking about capitalizing?
In my experience, it's better to use like the KeyBank SaaS survey because it has a median ARR. Companies, including that survey, have a median ARR of 8 million. And so if you're in that range, it's better to use something like that.
Yeah.
SaaS Capital has a survey too, right? I had a question on the capitalized software, Eric, which will tell everybody this isn't a super scripted webinar. Do you mean like the actual product that they're selling, you're capitalizing?
Oh, no. Referencing internal use software, this is software that the company is building for its own use. I guess the great example is Slack. When it was started as a video game company, they built Slack for its internal use. And so if they were at size and they continue to use it for internal use, that the messaging app itself should have been capitalized. The R&D work should have been capitalized and allocated, amortized over life. Now, in that case, it would have been inside in R&D. What I'm talking about is a lot of companies will build software, create software that directly supports the customer activity. And the ones that come to mind typically are a billing system. So there are a lot of billing systems, but the portal to accept the transactions, and then there's typically a reporting package that goes along with that. And so the company actually has to, typically the company will build proprietary software, and that's what can be capitalized and amortized over.
Okay, so it's a SaaS company building its software to support its customers. It's not its product.
That's correct.
Which is a whole different
internal business.
Just want to make that clear. Yep. Okay.
So just a quick, there's a lot of great questions in chat, and please keep them coming. One was just a question about what professional services is. Professional services, in terms of how we're talking about it, are billable services. So not software and not standardized services, but billable services that the company provides in order to support the implementation or the onboarding or the customization of a software product. But then there's an interesting question I hadn't thought of before that says, would you exclude professional service management, the non-billable employees from COGs? I wouldn't think so, but maybe you'd put them in G&A. I don't know. What do you think, Eric?
If a company is large enough to have a professional services organization that needs heavy management, then there should be an allocation. So some portion of that, think of it as like G&A to the rest of the company, but some portion of that, actually, I have seen it allocated into sales and marketing, or into sales and marketing and professional services line, and then the professional services folks that are actually billing, their salaries will go into their salary and associated expenses will go in the cost of revenue. So I have seen that allocation, yes.
Okay, great. And then just a perennial question, I think we did talk about it, but just to repeat the question, any best practices to share on how to attribute engineering costs to product operating expenses versus COGS? This becomes difficult when engineers work on product, building new features, and do customer work as well. So, and I appreciated your comment, Eric, and I'm hoping our OPEXEngine CFO is listening, to the distinguishing between hosting of the product and the hosting expense for internal, dev and product development work, which sits in R&D. So that expense is there, but it is COGS expense because it's belongs there. But
That's right.
any other comments on the R&D expenses?
I haven't seen, if you get bigger, you do time tracking and things like that. But usually there's a pretty clear distinction between these are the engineers that keep the system up and running, they go in COGS, and these are the people who are building stuff. And I again feel for the folks who are early in allocating, but make your best guess and stick with it and review it annually.
Absolutely.
I absolutely agree with that for smaller companies, yes.
So let's, we've already sort of touched on this a little bit, but I think we can continue going through. These are the gray areas: customer success, R&D, hosting, as well as security. And security is obviously a growing area that companies are making more and more investments in. And we get loads of questions about that. There's the security investment that you're making for your business operations and your people, and there's the security that you're investing in for your product. But especially with bigger companies, oftentimes they have one internal IT security organization that handles the full range. So how much of that goes into, how do you apportion it out? And do you have thoughts on that, Eric? You've worked with big and small companies.
Well, specifically on security, it is tough because there are use cases for security with respect to your customer, and there are use cases with respect to your employees. If you say use Okta, for example, and you require employees to validate, their as two-party authentication and use that again, that would be obviously a G&A function, right? If you have that for your customers and require use the same software for the customer, that would be part of cost of revenue. I think it depends a lot. I think on smaller companies, you don't necessarily have to do that. In larger companies, where it becomes material to your business, then you should be doing that.
Yeah, and that's where it gets really complicated, because in smaller companies, sometimes your dev team might be doing some of the security for your employees, because you sort of bleed between IT development and business security with the same folks. Let's jump back to customer success, because this is an area that we get millions of questions about. And in our benchmarking, we ask that companies benchmark their customer success expense and headcount, but also tell us what percentage they allocate to COGS. And it really runs the gamut. And a lot of that, I think, relates to what is the purpose of your customer success, because it's an organization that can be doing, can be fully within your sales organization, and it's really just a renewal organization or an upselling organization and primary goal. And you have people with customer success folks that are on commission plans based on the revenue that they sell, which would be associated with sales, versus other customer success organizations that are much more focused on the engagement of the customer, the ease of use, the happiness, the customer satisfaction of the customer with your product, and sales is not part of that. So what have you seen, Todd, in a lot of different small companies?
Yes, look, customer success didn't exist basically, 7 years ago? So we're all sort of—
Thanks to Gainsight, we now all have customer success organization.
So there's some clear lines, right? Like Eric mentioned, you're answering the phone, you're resetting passwords, you're doing really basic support stuff, clearly in COGS. There's other clear lines, which is, hey, I primarily do cross-selling and upselling, and I'm in the customer success organization, but my job is to grow revenue. And then for the folks who are just focused on retention, and sometimes that doesn't even exist, but there in some organizations, it's like, okay, your goal is gross dollar retention, right? And if you see the opportunity for a cross-sell upsell, you throw that over to sales. So those folks we've seen go either way, right? So we've seen some people say, hey, this is mostly renewals. It's mostly supporting the revenue, the ongoing revenue line item. That's a cost of goods sold. Now, Eric would quibble with that because there might not be the right matching principle, right? They're working on future revenue streams as opposed to this revenue streams. But I also think it's the matching principle gets violated lots of ways and sometimes for very good reasons. So, you know, I don't know that it's not a bad way to think about your business either, because it's not sales. It's really there to support that existing revenue stream. And if you didn't have those folks, that existing revenue stream would tail off and those customers would not be supported near as well as they are. So sorry for the grayness, but we've seen it done both ways. I think if you're clear about it and you can defend it, then either way is fine. The caveat being that's for small businesses. Maybe for the public companies, they've all landed on sort of one side of that argument or the other.
I agree with Todd. It is a gray area. And I do agree with you, Todd, too, that, you know, really with all these metrics, with all these decisions, you know, take the best information you have available, form an opinion, document it, and then don't deviate from that opinion. And eventually you'll get, you know, audits, and you know, you can change then, and you'll get buy-in from the auditors and your audit committee. And I do think obviously it's as companies get bigger, the more specialization you see within these groups, and the easier it is to identify what's a direct cost and indirect cost. My final point on customer success, and going to Todd, is I think about it in that I do think about it in terms of the matching principle, in that if the customer success people are working on happiness or working on upsell, cross-sell, that benefits the company over long term, so it increases your lifetime value, then that is something that should be in sales and marketing, because it's not directly improving revenue in that period.
Yeah. So I think people can disagree on that.
And I should have said early on, we are not, none of us are accountants. And
there should have been a big caveat.
We should have had that caveat all across everything. This is what our experience is, all three of us from different perspectives, but you should always check with your accounting firm for the final answer. And make sure that your accounting firm is experienced in SaaS.
Right. This is labeled gray area, so they are, yeah.
Exactly. So there was a question in the chat about implementation services, but it's unclear, you know, and whether you would include the cost of implementation in COGS. I'm not sure if they're talking about when you charge for it or if you don't charge for it, but either way, you know, for some companies, there is an implementation service that's folded into the subscription price. And then for other companies, you pay a subscription price and then they charge you for implementation. And, you know, sometimes that depends on just pricing policy, and sometimes it depends on how long the implementation takes. Eric, do you see any difference with those two situations, and whether they would both be in the expense of the implementation would be part of COGS?
This is great. It's a great question, because I do hear this all the time. And my feedback is always that the decision on whether or not to charge is a business decision. And regardless, if it's almost always the case where the implementation, let me say it like this. If the implementation is required for the product to work effectively, so that's engineers connecting APIs, or maybe installing a piece of software, or maybe you have they have a kernel of software that has to be in the AWS instance or in your virtual instance. that work is required for the product to work and therefore should be in cost of revenue.
Okay,
Yeah, I agree
And-
100%. Yeah.
great. Just
I've
a
never
quick
seen
question.
implementation revenue. I
Sorry,
would just say
go
I've
ahead.
never seen it below the line. So that's a pretty standard COGS. Yeah.
Yeah, I mean, that's what we would typically see. Quick question, just further on security. It says, how about compliance costs and expenses, GDPR, PCI, Nexus reporting? I mean, well, if the GDPR, GRP, I can't say it. Yes, thank you. If it's for your marketing, that's one thing. If it's related to your product and your customers using your product, that would be a different thing, right? Eric, what would you say?
That's right. The most material expense associated with GDPR is having to spin up a virtual instance in Europe. And so, and that is designed because GDPR requires that, well, one of the requirements is that all the data has to be stored within the European Union. And so that's clearly a cost of revenue expense. There are GDPR audits. You may have if you're a larger company, you may have hired somebody to respond to GDPR requests. So if you're familiar with it, if I'm an employee of a customer and I used your product, my company bought your product, I can call you. If I'm European, I can call you and say, delete all my information, any information that has my name on it, and then send me a notification that you've done so. That's a typical GDPR requirement. And so in that case, that would still be in probably a customer success function. But the most material aspect of the GDPR lies in cost of revenue, which is the virtual instance and any tools inside of that are offered by your web hosting company to allow you to be GDPR compliant. And the same thing with a lot of other compliance issues. Although I will say, like a SOC 2 audit, that would be in R&D because it supports the business going forward, and it can't be tied to value in a specific period, revenue in a specific period.
I would like to put it in COGS, but I've heard that also. There's a question on for companies that offer professional services, whether implementation or independent services offering, is it typical to split out the software gross margin and the services gross margin separately? I know, it's an interesting question because probably 8 to 10 years ago now, if you think about it in the SaaS industry, it was much more common for enterprise SaaS companies to have fairly significant professional services organizations as a business model. And we, OPEXEngine, benchmark both, product cost of goods and services cost of goods, and, produce a gross margin for product, a gross margin for services, as well as a company gross margin. And at the time, it was considered, a great way to, I can even, I won't mention names, but some quite well-known and successful CFOs in the SaaS industry who said, absolutely, we run, professional services at cost. We have very low margin. It's a retention management tool. It's a, implementation, getting companies to up to using our product faster. With product-led growth and that, model, I think it's really pushed down the number of companies that are really building out professional services. And I think investors have become less supportive of big professional services organizations. But I would say that it is still typical to separate them out, because what you really want to do is show how you have this great product gross margin. Any comment on that from Todd or Eric?
Yeah,
Go ahead, Todd.
I tried to make that point earlier and maybe not successfully, but I do think at any scale, being able to isolate sort of your product gross margin from your services gross margin just helps the investors understand your business better, and you shouldn't, said differently, shouldn't be heavily penalized for running services at break even. You know, it's to some degree a sales and marketing investment. What they really care about is, you know, the size of your product revenue stream and its gross margin. So it just provides transparency, and the investors can make, they can make whatever decisions they want, and then the management team can too. I mean, I remember asking this question of dozens of SaaS companies, and they're like, oh, I don't know if we make money on professional services or not. I'm like, well, you should, right? If you're investing in that area and you're running at a loss, you should know that, right? And you know, the flip is true too.
Well, I agree with you absolutely, Todd, and I would add, you know, just as Todd, as an investor, you're seeking that information, you know, so is the CEO and the management team.
Yeah,
and
right.
the job of the CFO is to be the business partner to the CEO and the management team. So you will need to provide that information so everyone can make a business decision. And actually, this is such a great question because it's very hard to, a lot of companies have a difficult time putting a gross profit margin on professional services. And because the systems aren't there, or they're not tracking the time, or, you know, services are done after implementation, people get pulled in, you know, in that direction where it's not directly billable. And then I think so that's the first point. The second point is that you have to break it out if you want to benchmark. So I always throw out a number of, you know, good professional services margin is 40%. So you should be, if you have to see it in order to benchmark. And I think the other, and this is probably most important with respect to strategy, but the professional services is by definition manual work. And what we're doing in this business and software business is writing software to displace labor. And so the company as a strategy should be building software that eliminates the need for professional services to some degree, and innovating over time to reduce the professional services revenue.
Yep.
And I think that's what an investor is looking at, even if you have a margin or you have professional services. Is this a product that can get to the point where it doesn't require people to implement it and customize it and for customers to use it, or at least not at a bad margin?
And we're talking just about margin, but there's also just real dollars involved too. So a lot of early stage companies, they're like, oh my gosh, professional services, it's only a 40% gross margin. I'm like, yeah, but it's actually delivering dollars.
Yeah.
And cash is good, right?
Yes.
And so cash can be reinvested in product and whatnot. So don't get too wrapped up in your overall gross margin if it's being drugged down by professional services, if you're making gross margin dollars on those.
Well, sorry, but to tag on, that's such a great point, because if you do sell a large professional services, you do bring in the cash, but then you're also gaining insights about the customer's use case that you may not understand if you had not done that deal.
Which again, for a smaller company or private companies, that's critical. And it's not easy to get that kind of insight if you just sell the software and go to the next one. There's, on some of the questions in chat, it's interesting, some of them border between cost of customer acquisition and gross margin. And just taking one that's sort of interesting, so user conferences. So typically we would say, we at OPEXEngine would say a user conference, if it's 100% or 90% focused on users, then that marketing expense should not be part of your cost of new customer acquisition because it's aimed at your existing customers. So the question here is, would you consider that part of COGS? Is that like customer success that's focused on engagement, or how would you refer to that? Well,
going back to the customer success discussion, if it's customer success is about making customers successful and adding value over a long period of time. And so a user conference, it may even be run by customer success people, or at least there'll be then a user conference if marketing's running it, but it's also designed to improve the customer health, improve engagement, and therefore should be in sales and marketing. And I think the more important point here for me is that I think if you start finding yourself splitting up sales and marketing between OPEX and cost of revenue, I think you're overthinking it. And at the end of the day, your LTV to CAC will still be the same. We're just moving it from denominator to the numerator. And so in my view, there's no value in trying to move sales and marketing expenses to revenue or worse, or cost of revenue or worse to R&D, or exclude it from your LTV to CAC calculation, which I actually see a lot of people doing.
Yeah.
I've never seen customer conferences anywhere other than sales and marketing. I can't imagine putting those in COGS.
So it brings up a conversation that we had in our prep call, which I think is interesting to bring up here, is that part of why this is so hard is, as you've mentioned, the lack of guidance. Part of it is because it is, you're doing different things in different areas, and there's a lot of merging between them that belong into COGS versus OPEX. But then I think there's a third component that we all talked about that I think is worth sharing, is it also, you have a lot of people who are trained in accounting who, expect to have things fit into very clear buckets, but the organization of SaaS companies doesn't match those buckets anymore. And maybe you could speak to that a little bit, Eric, in terms of your work of going into companies and helping to build out the finance organization and structuring it for success for a SaaS company.
Yeah, that's a great comment. I typically, I work in more later stage venture and private equity, and so most of the work in terms of the organization there involves changing the chart of accounts to provide for increased reporting accuracy and precision, really reporting precision, and bringing on more specialized operators, particularly folks who know and understand SaaS and are immersed in that business.
Yeah, absolutely. So I'm going to move on. I think we've talked a lot about these various areas, but let's just, and please, folks, if you have any other specific questions about COGS or higher level questions, we do have one on going back to the discussion about valuations and how COGS is important to valuations. But before we get into that, I think it's important to also focus on just the basic message that we want to get across, is that it's important to get your COGS right and also understand who your peer companies are, and your peer companies have a similar model to you. So if you are comparing yourself, if you do have a big professional services organization, which brings down your overall gross margin, but your product gross margin is quite high, and that's the stage or where you want to be right now, then you probably should not benchmark yourself against a product-led growth company that has no professional services. And you should be able to articulate that to your investors, and you should be able to get benchmarks for companies like yours, not, the general market benchmarks that are out there.
On a proxy for that, maybe, and I know a lot of the SaaS capital metrics were broken down like this, and I think many of yours is by average selling price. So if the average selling price is very high, that's a sales-led organization that's going to have a decent amount of professional services revenue. If it's a lower average selling price, more likely to be product-led growth with very little mix of services revenue and the associated impact on gross margin. So, because I don't think people are breaking out. So if you're doing it yourself and you know the business model, you can navigate the benchmarking. But I don't, have you guys done anything like these are product-led growth businesses and these are sales?
Yeah, so we have filters so that you can,
great.
The way our platform works is the company, the mission of OPEXEngine is to create which we've been doing for 15 years, and we have almost 1,000 companies that have benchmarked with us, and so everyone's data is blinded in the database, and then you see your own data and you can apply filters against the blinded database. And the filters are based on these kind of different, not just revenue size and growth rate, but average contract value and different filters so that you can really create a cohort of anonymous companies that fit whatever filters you apply against it.
And you have a PLG versus sales-led growth filter?
We haven't labeled it that way because while PLG is really well described, and I'd love to have this conversation with a bunch of people, you still see all sorts of different business metrics that are associated with, a big range. So it's not like all PLG companies have a certain EBITDA, certain average contract value, certain,
Right.
But you can segment out like companies with lots of professional services versus ones.
Yeah, and I just say, I think ACV is one of those filters you could use for sure to help get to a better cohort. Yeah.
Exactly.
I think you can also see it in the gross margins, right? If you look at a company like, well, you had Asana up there, but Asana is a very intuitive platform. It's a very robust enterprise platform. It does not require a lot of implementation or integration, or if it does, it's the customer actually doing it. The customer hires the SI because it's just such an advanced technology. And compare that to a company that maybe has a hybrid approach that's not, and therefore it's not as valuable. And I think Todd's comment on the ASP is really important because the gross margin in that context also reflects pricing power as well as the product-led, the advanced technology, that the robustness of the platform.
Mm-hmm.
So there's an interesting question here on COGS and how it impacts pricing and discounting strategy, and particularly in a consumption-based pricing model where you need to give guidance to the salespeople in terms of how much they can discount the deal without going below a threshold that's going to affect, I'm sort of paraphrasing, but you want to give them a threshold where it's not going to go below and affect margins. And if you have hosting and infrastructure costs that are obviously associated with, big swings in usage, which can be associated with consumption-based pricing. Any thoughts about that? Todd's nodding his head.
No, I have no answers, but it's a great question. A lot of application layer, lighter business logic SaaS companies don't have to worry about this at all. But if you're doing heavy lifting and heavy compute, or there's a communications component, you absolutely have to think about it. And usually if you're doing consumption-based pricing, it helps solve that, right? Because if they use a lot of it, they'll pay more. But in some cases, it doesn't match up. And I think a big problem that is very hard to attack is customer profitability, which this is the beginning of that, right? You try to set it up as best you can, but then you get into it and like your AWS bill is just this big bill, right? And you don't necessarily know, you may have customers that are literally losing you money, and it's at the current point in time, it's hard to sort of filter that out and know. And Eric, maybe you've done customer profitability, but it's relative to AWS bills, but I haven't heard of anybody.
Customer profitability almost always, well, always uncovers this. And in every single company, either it's available and no one looks at it, or I have it produced and it shows how we're doing that. And this is a great place for me to make my pitch that Deal Desk should always report to the CFO. So let me sneak that in here at the end of the webinar.
Well, luckily, we don't have a lot of heads of sales on this webinar, I believe, from what we've seen. That would be a really interesting discussion to have, but I do think it does make sense to have it on the finance or on the CFO side. But
I'll probably get a lot of feedback on that comment, but I'll take it.
I think you're getting some chat responses of you're preaching to the choir, which may just mean that basically everyone on this call is on the finance side. So we have a number of other questions. We'll share the questions out, but please keep them coming. I want to be sensitive to everybody's time, and also to our great speakers. Thank you so much. You guys are fabulous.
Thanks, Lauren.
Thank you, Lauren, for having us.
Yeah.
Excellent. Thank you. Take care, everyone, and sign up next month for Whitney. What is our next webinar? It is on international expansion.
Yes, that would be on the 10th of March, and then we have, that's with Paddle, and then we have another webinar happening on the 23rd with Jellyfish, and that's going to be on R&D ROI.
Cool.
All good topics. Great. Thanks, everyone. Take care.
Bye.
Bye.